Hello, Market Rebels and all of our YouTubers out there. Welcome back. We do this every Monday at 4 p.m. on the closing bell. This is Trading Tune-Up, just to give you some ideas to help you make better decisions and become better options traders. So today, I thought what would be a good topic before we go into our Thanksgiving holiday weekend here is something that usually puzzles a lot of traders who sell calls. So this could be part of a covered call, could be maybe part of a stock replacement diagonal spread, but anytime you are selling calls, actually selling options in general, but for this presentation, I'm just going to use calls, there is a very perplexing puzzle. We get questions on it all the time. So let's take a look at what the covered call puzzle is all about, why it exists, and how to make better sense of it. So the idea here is that for a covered call, we're going to buy shares of stock, we're going to sell calls against it in what's called a 1-to-1 ratio. And that just means if you have 100 shares, you could sell one call, 500 shares, you could sell 5 calls, and so on. So if you have, by selling the calls, you receive cash. And by receiving the cash and selling this call, you have the obligation to sell the shares for that strike price. Now, the puzzle that people come into is that you receive cash. And a lot of times they'll say, well, I read somewhere that if you sell the option that you are credited this cash immediately to your account. And they go, but I don't see it. And in fact, sometimes it looks like I lose money. So where is this cash going? Why am I not seeing the cash from the sale of this call? So for a covered call, this is the risk graph that we get, this hockey stick. And there's the bend. So if we sell a $100 call for $5, the maximum we can make is 5. We can see that the risk is here to the downside. So to make this easier to understand, we're going to start with a perfectly clean slate. You just open the account. There's no cash in it. We're going to deposit cash, and that's just going to make it easier to follow. So we got $10,000 in the account, and what's going to happen, you are going to buy 100 shares trading for $100 per share. And then you're going to sell this $100 call for $5. So the thing is that you would think that upon selling that call, that your account balance should now show $10,500. You had $10,000, you just collected $500, but you might even see $10,000 or you might see $99.90. And this is the puzzle. Traders are going, where did the money go? I should be seeing $500 in here. So that's the big puzzle. And it's a good question because you're going, I just sold it. How, and I collected money. If I sold my shares, I'd see the cash in here. Why am I not seeing it from this option? Well, it's a really good question, but it is true that when you sell an option, you are credited the cash immediately. But what they're not understanding, these traders that have this question, is that there's also a matching liability. And it's only over time that this liability is going to wither away that extrinsic value, and that's what eventually credits the cash to your account. So here's the way that it works. We're going to start with a clean slate. This is a hypothetical broker's platform, and you've got $10,000 cash. You have no positions, and therefore you look at your account and it says that the total value is $10,000. Simple enough. So you go and you buy 100 shares, and then what happens? You've got 0 cash. Your positions show $10,000 worth of stock, right? It'll show long 100 shares worth $10,000, and no change to your account. You have simply swapped it from cash to stock. So far, so good. But now we sell this option and we see $500 cash credited to our account. And the positions now show that we are short this ABC call for minus 500. And yes, we're still long the shares of stock. So notice what happens. Our total account value is still 10,000. This is the answer to the mystery. Yes, you do get cash credited to your account. There's the plus 500, but you can't just close the account and say, thank you very much for the cash and take off. You have to either let those shares go or buy back this obligation, or maybe hopefully it will expire worthless, but you need to be out of the contract before you could just close up the account or say, I now have earned this cash. But if the option's worth 500 when you sold it, what would it cost you right now to buy it back? Well, presumably also 500. So they're going to give that short call, -1 over here, a value of minus 500. So notice that the plus 500 cash and the minus 500 for the call cancel. And so really the way that your broker sees it is that you just have $10,000 here in stock, and that's why your total account value doesn't change. But it could be even worse. What if we see that our options quote, we might see a bid of 5 and an offer of 510. Now, normally when you sell an option, you're going to receive the bid. So in my example, that's where the $5 was coming from. But if you had to close it right now, what's the smarter way for the broker to say, this is what it would cost you to close your obligation? Well, you could certainly make a strong argument that it would be the asking price of 510. So some brokers are going to match, a lot of them will do it at the halfway point between the bid and the ask. So in this example would be 505. But a lot of them are going to say, if it's a long position, we're going to mark it to the bid because that's a price where we know right now you could close it. And if it's a short position, we're going to mark it to the asking price because we know right now that's where you could close it. So here's what could happen. You've got the $500 cash that you just received. You've got the short option showing minus 510. Your stock position is 10,000, and now your account shows 99.90. Talk about a puzzle. You're going, look, I just had $10,000. I was just looking at it, showed 10,000. I sell this call, I collect 500, and now it's saying I've got 99.90. I was expecting to have 10,500. And again, this is where traders are going, I just don't understand it. But this is really the answer, is that we have this corresponding obligation. So how do we get rid of this, or how do we account for this? Well, it comes over time. Let's say that over time, we're just going to keep the stock price the same. And what happens? We get time decay. So that option is no longer worth $500, whether we're marking it at the midpoint, at the bid or the offer, however your broker is doing it. Let's say right now they say that it has a value of 400. Your positions haven't changed. The stock price hasn't moved. What's the total account now? See, now your total account value is 10,100. You have, in a sense, earned $100. Yes, you have 500 cash, but now your liability has only sunk to 400. And that's why your account is now showing that increase of 100. Over time, maybe that option shows that it's worth 200. Stock doesn't move, it's still 10,000. Now your total account shows 10,300. And then finally, at expiration, if the option is, in this case, right at 100, stock is right at 100, the option expires worthless. It would cost us nothing to close it out, and the shares are still worth 10,000. And so now, and only now, does your account show 10,500. And that's because it's this tug of war between the cash that does not change. Once that's deposited, that's the most you can make. And you keep it no matter what happens to the option, up, down, unchanged, whatever. But this is what's causing the account value to rise. And so this is why you have to be careful. Sometimes people say, oh, you sell calls if you need income. So on the first of the month, you say, oh, I need income for whatever, pay a rent or a car payment, whatever. And you say, let me go sell a whole bunch of options. And you look at it and nothing has changed in your account. And that's because you really can't just withdraw that cash until that liability is closed. Now, this is where it gets a little tricky as well. You could do what's called margin cash available, but what you're really doing there is not withdrawing the cash that you receive from the option, you're just borrowing against your shares. So it's not really like you're just getting cash to go out and spend. It's this, again, a tug of war between the cash versus the value of the option. So just remember, for a covered call or whenever you are selling options of any kind as part of any strategy, the idea is the same. You do receive immediate cash. That is true. But you also have an attached liability. That's the big kicker that people forget. And so in accounting terms, we usually call this unearned revenue. It's revenue. We've received a lot of money, but we don't really call it earned until we've delivered whatever the goods are. And so it becomes, over time, it becomes earned revenue once we've fulfilled these obligations. And that's really what's happening here with the options. So you don't earn or realize that value until expiration. So once again, that is a very common question that we get. People go, I just don't understand. I sold all these options. My account is just not going up in value. Where does the money go? So hopefully this helps you to understand better. And remember, that's really the idea of trading tune-up. is to improve your performance. If you understand the ins and outs of options and the technicals, it helps you to make better decisions just because you know what to expect. And so for anyone who would like to take their trading to the next level, we are offering a free 30-minute one-on-one with one of our professional world-class coaches. Many of you are able to see them now on Coach's Corner, which we do Thursday also at 4 p.m. Please join us for that. But you can get a free 30-minute session. So you can talk to Stu or Elliot or Scotty or any of our coaches for 30 minutes, any topic that you want. And the phone number there is 888-809-8058. And so I hope that helps you to make a little more sense of what's otherwise a very puzzling topic. And last but not least, I want to wish everybody a very fabulous Thanksgiving Day. We're underwater down here in South Florida, but hey, at least it's not a hurricane, so something else to be thankful for. But I want to wish everybody a fabulous Thanksgiving and weekend, and we'll look for you next week. We'll see you then.